Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, January 4th, 2021, and I'm pre recording this Trading Places Live for Tuesday, January 5th. Futures are slightly higher after a day of pretty heavy selling, at least in the morning, and that was followed by a recovery on Monday afternoon, but still, the market did start off the year on a rather sour note. Going to get into all of that in just a couple minutes. I do want to talk a little bit first about the agenda today. Happy New Year to everyone. This is the first Trading Places live show here at StockCharts of 2021. We had quite a year in 2020, got through a lot together, and certainly hoping, wishing everyone has a much better 2021. There'll be plenty of trials and tribulations to get through, but I do expect 2021 to be a good year in the financial markets, and I think together we'll get through it just fine. Let's go through the agenda for this first show of 2021. I'm going to go through the daily market recap with you. Everything that took place on Monday. Then we'll get into talking technically. Just want to take a look at the benchmark S&P 500. We did have a lot of selling in the morning, so I just want to look at some numbers there, some things that maybe we can be looking for in the near term. Then we'll get into relative strength. I want to go through and take a look at some of the industry groups, some of the areas that are leading the market, especially in the aggressive sectors, some of the industry groups within those aggressive sectors. I think that's going to be really important as we move into throughout the first quarter, really, of 2021. Then I'm going to get into a mailbag. I think I'm going to do this once in a while where just go through some questions, some member questions about how I look at the market, how I use stock charts, whatever. So I think it'll be a good segment to go through the mailbag occasionally. And then we're going to wrap up the show today with the three you must see. And this one's going to be interesting because I do have three different stocks. One that looks like it should hold support. Another one that's actually trying to make a breakout and looks pretty good on the chart. And then the third one that's been under a lot of selling pressure. I think you're going to recognize this name. It's been under a lot of selling pressure the past few months, but I'm still very bullish the stock and may have started to make a little turnaround on Monday. We'll have to see. But we're going to get into all that in just a minute. I do want to just point out to everyone, if you go over to earningsbeats.com, love for you to sign up for our free Earnings Beats Digest newsletter. It comes out 3 times a week, Mondays, Wednesdays, and Fridays. Normally is published in the morning before the market opens. All you need is your name and email address. Hit that subscribe button and we'll add you to the list. It's a great community. I'm very thankful for all the support that Earnings Beats received in 2020. We look forward to another great year in 2021. And I just want to really thank all of you for your support in 2020. It means a lot to us. All right, let's move on to the daily market recap. So Monday was kind of a strange day. I mean, the selling was really unrelenting for 2 or 3 hours. I mean, the first half of the trading day, we saw very little buying. We opened up and then we sold off. And if you look at all the major indices, we actually traded below the 20-day moving average on all of our major indices listed here. But we recovered and closed back above those 20-day in all 5 cases. So yes, short term, there was some selling. It certainly felt bad. The recovery was nice. I'm not sure the selling is over just yet. We do have, if you look at these PPOs, look at the Dow coming down, S&P coming down, NASDAQ down, mid caps down, small caps down, all while the market's been trying to go higher. We could, all of this could result in a pause in the market. I wouldn't be surprised if we go sideways here for a little bit. If we do continue to move up, watch those PPOs. If they don't rise with prices going up, then I think we're probably going to be heading into a period of consolidation if we're not already in one. But the Dow Jones Industrial Average finished down 382 points. I think at the low we were down about 700. I mean, it was a pretty nasty day to start out the year. S&P 500 down 55, 1.5%. Nasdaq also down 1.5%. It finished down almost 200 points on the day. Mid caps down about 1.6%. Small caps down only about 1%, just a tad over 1%. So on a relative basis, small caps actually held up the best. We'll see whether or not that trend continues, but at least for now, looks pretty good. The other thing I'll point out, and I think this is somewhat important too, throughout 2020, even when we saw selling early, but then we would see buying later in the day. And as a result, what we saw was the accumulation distribution line going higher throughout much of 2020. So I thought that was at least something to take away from Monday's action as well, in that we started off strong. It looked like we were going to have a really big distribution day, but then the market came back in the last few hours in the afternoon on Monday, and it was not nearly as bad as it could have been. And with the volatility index surging throughout the day, it could have gotten a lot worse in the afternoon, and it didn't. So we'll just take a small victory there. As far as the sectors go, energy, that was the best performing group, and it was the only group in positive territory on Monday. It did finish up fractionally. We're still hovering. You can see we've been straddling this 20-day moving average. So on Monday, we did move up 6 pennies from 37.90 to 37.96, but we are still, like I said, straddling that 20-day moving average. Real estate, utilities, and industrials, all three of these groups really hit pretty hard on Monday. Real estate down more than 3%. And you can see back down near this gap support area from the gap back in early November from the vaccine news. So we keep going back down to around this 35.20, 35.25 area, closed on Monday at 35.38. So that's going to be something to watch on Tuesday. Utilities, after getting up to the 50-day moving average, trying to get through 63, rolled back over again. Finished at 61.12. That's essentially where we broke out from the high that we had back in August, just over 60, maybe close to 61. We broke out, went up to 67.5, and now we've worked our way back down around that 61 level. So watch that level as well. Industrials down about 2.5% on Monday. This is a group that's been going up and more just sideways consolidation. I mean, I see a bull flag here. You can see the flagpole and then this sideways consolidation after it. Generally speaking, you would expect anyway, this to break out to the upside. In the meantime, watch gap support. I think that 85 level, that's right about where the 50-day moving average is. That would be an area to keep an eye on to the downside. As far as industry groups go, recreational services took a pretty big hit. It wasn't that long ago, maybe 4 weeks ago, that we saw recreational services trying to break above 100. After the loss on Monday of more than 5%, we were back down to 87 and change, testing these prior lows. Also, not too far from that gap support and the 50-day moving average. So recreational services needs to turn around pretty soon. Good news is the AD line has been going higher in this group for a while. So it does appear as though we're getting some accumulation, but that was not the case on Monday. We did see some selling there. All right, let's move on to the 10-year Treasury yield as far as economic reports on Tuesday. Just one. We've got the December ISM manufacturing report due out in the morning, and current estimates are at 56.5. November number was 57.5. So we are looking for a pullback of 1 point down to 56.5 for December. Looking at the 10-year Treasury yield, as I mentioned on my Trading Places show over at Earnings Beats on Monday, we've got equal highs here coming off of this uptrend. We've got equal highs and rising lows. So we do have an ascending triangle in play. And if we could break out above that 0.97, 0.98 level, that would probably measure up to about 110 to 115, 1.10 to 1.15. Ultimately, and I'm looking out, the next few months, I think we're going to make a run for that high that we saw back in March. maybe around 1.30, between 1.30, 1.35 is what I would be looking for. But it's going to take a little while, and getting there, if we do get there, any kind of a rise like that should bode well for financials. So I do think financials have an opportunity here in the near term, although the Fed has said, and I agree, that rates are going to remain low for quite some time. So that makes it, at least provides some headwinds for financials. If interest rates are flat, unable to move much higher, that's going to be difficult. They can make money. It's just I don't know how much they're going to be able to grow their earnings. And as long as rates do remain low, high growth is likely to remain in favor. And so if financials aren't growing that rapidly, I think outside of maybe some short-term movement to the upside as a result of Treasury yields moving up, I don't know that financials necessarily are the place to be for the year of 2021. All right, let's move on. I'm going to talk a little bit here and talking technically about the S&P 500. So one thing I want to point out first, I mentioned the accumulation distribution line, and I've got it down here on the bottom of this chart. You can just see it's been going up for the last year. Even through the pandemic in February. In February, we had this first drop. You can see the AD line went down. But then as we went to new lows, way deeper lows in the middle to latter part of March, the AD line never went below the late February low. And a lot of that was because we would finish back toward the high of the day on many of these days with heavy volume. So we were getting a mixture. We were getting some days where the AD line was rising, some other days, like when we had these red candles, filled candles, we would see the AD line pulling back, but we never took out that prior low. And that was a theme that really carried us at earnings beats in 2020. And that's why when we saw the selling on Monday and the big drop, we got down as low as 36.62 and came back up and closed at 3,700. That's 1 percentage point off of the low in terms of the close on Monday. So that was a good recovery in the afternoon, and that helped to mitigate some of the decline in the AD line. We did see a little bit of a dip on Monday, but it wasn't that bad, and that's because we did rally off of those lows in the second half of the day. So a little bit of a mixed bag in terms of what transpired on Monday, but it could have been a lot worse, as I said earlier. So as I look at the S&P 500, I see a S&P 500 that consolidated for a period of time. We got to that high in September. You can see we failed to get through in November with the vaccine news, went sideways. But once we made a definitive breakout, notice we had not, or we still have not closed below the 20-day moving average. Now, it's going to happen at some point. We're going to probably trade sideways and maybe move back down closer to 3,600. I wouldn't be surprised. But I don't think we're going to go much lower than 3,600. I would be surprised. I think, 3,580 to 3,620 is what I was telling Earnings Beats members today in my daily market report. That's an area that I would watch very closely if we do see some additional selling from the fallout on Monday. But overall, I believe the market goes higher. I think we're in a secular bull market. I would not want to be out of this market. I know it's tempting after the huge gains to say, hey, let's get out. Let's wait for this big pullback. I just don't see signs that tell me we're going to get a big pullback. 3-4% can happen at any time. Maybe further down the road, maybe when we get past the first quarter, I wouldn't be shocked to see maybe a 10% correction at some point in 2021. But I believe that we are going to go mostly higher throughout the year. So I'm not interested in moving to cash and waiting for this big correction because I just don't know when it's going to come. I don't see the signs for it just yet. All right. Another S&P 500 chart I was going to show you is the 60-minute chart. So this goes back the last 2 months. And one thing I wanted to show, let me annotate this. So if you look at this, if you look at the chart here, on the high at the open today on Monday, you can see the higher prices and you see the lower PPO. So we had a negative divergence, and then we had a pretty significant pullback after that. If you go back and you look, say, December 9th, as we were moving up these highs right here, notice the PPO was lower. And there's the selling. We went right down below the 20, below the 50, went all the way back down into this gap support zone. We tested it a couple times, and then we broke back out above these prior highs. Now, the selling did pick up, volume picked up, but we're not down below these lows. This is 36. I mean, gap support's around 36.20, 36.25. So that was the range that I gave you. Also, there's gap support down here at 35.80. I think that combination is, when you look at it on the daily chart, 35.80. Let's go back over here. 35.80 is right about in here, right about this breakout of the September high. 36.20 was the gap support I was telling you about. Then you've got the 50-day coming in at 35.90, right in the middle of all that. So that's what I would be looking for. But here you can see that positive move up in terms of price action, but the negative divergence with the PPO not following suit. And that set us up for some selling. Now, we traded below the 20. I think you have to respect the 20-hour EMA in the short term. So if we're up on Tuesday and we're going up and we're challenging this 20-hour, let's see what happens. We could easily roll back over again, possibly even take out Monday's low and go down and challenge these lows from back in December. I don't know that that's what we're going to do, but I wouldn't be shocked. I mean, we've had a big run, so it's okay if the market consolidates. Any kind of a base is actually a good thing for the longer term. If we get back through the 20-hour EMA, we may just simply resume the uptrend that we've been in. I think that would be very bullish. So watch that 20-hour EMA. All right, let's move on. I want to talk a little bit about relative strength and specifically some industry groups within the aggressive areas. Now, I'm looking at technology right now, and this is computer services, and this is a relative chart of computer services versus the S&P 500. When it's going down like this and it's below the 20, which is below the 50, and the weekly relative PPO is in negative territory, I'm not interested. This is telling me that there is bearish momentum in this group. Not bullish, bearish. And so I have no interest in trying to catch a bottom. Now, as I go through some of these other groups, I think you'll see some differences. Here are semiconductors. Here, relative price action has been moving up for a year and a half, and we're trading above the 20-hour EMA, or excuse me, 20-week EMA, and that's above the 50-week SMA. So pretty good configuration there. Check out the relative PPO. It's been above zero all the way since August of last year. So really good action in semiconductors. And at this point, I see no reason why you wouldn't want to continue to trade within this group. Software. Software has been consolidating. It's not been performing badly. You look at this and say, well, you know, it topped back in July and it's been rolling over. Well, it didn't top in July. Here's the top in July. We've moved to new highs. What this is telling us, though, is that we're not seeing the same relative strength in software that we had seen previously. So, but it's still, you know, we're still above the zero line. I expect that we're going to get another pop in software, and I wouldn't be surprised to see it pretty soon. On an absolute basis, we continue to move up. We're in a nice uptrend. All right, looking at electronic equipment, one of the strongest areas of the market. No doubt over the last 2 or 3 months, this has been one of those moves that you can't help but notice. Electronic equipment has been outperforming the S&P 500 by an extremely wide margin, and this is a group that we want to pay attention to. And once we broke above these prior highs, that's when the relative strength really took off. Computer hardware remains pretty solid here on a relative basis, kind of going sideways. But again, on an absolute basis, we're moving higher. Nothing wrong with what's going on here. Electrical components showing strength. After the relative PPO was in negative territory most of the last 2.5 years, the last 4 or 5 months, we've actually broken out, and you can see now the configuration where relative price action's above the 20, which is above the 50, and the relative PPO is very strong. Telecom equipment still continues to trend lower, has been trending lower now for over 1.5 years. No interest in this group. Consumer discretionary. We'll go ahead and take a quick look here at consumer discretionary. And then we'll call it quits for the relative strength. But hotels, definitely strengthening. We're pulling back on a relative basis over the last maybe 5 weeks or so. But the overall trend here is up. The 20's crossed over the 50. Relative PPO is positive. So there's some pretty good things going on here. But we still got a long way to go to get back to where we were at the end of 2019 and early 2020. So yes, we're improving. Things are getting better. We're not anywhere near where we were. Toys just broke out to a new 2.25 year relative high. So that's looking good. PPO's turned back up again. Good action there. Restaurants, not really looking very good. Last 4 or 5 months here, you can see this relative low that we're at actually takes out all these prior lows. And so we are now trading at about a 4 or 5 month relative low in the restaurants. PPO is positive, but barely. Specialized consumer services, I think this group remains pretty solid. Nice relative uptrend in play, bounced off the relative 20-week EMA. Didn't quite make a breakout. It's pulling back again. I think we're just consolidating. But you can see, again, on an absolute basis, we're going higher, trending higher, which is nice. Clothing and accessories, one of the strengthening groups in the market. I like what's happening here. Notice the last relative pullback, tested that 20-week EMA and bounced, went up to new highs again. Relative PPO strong. And down here, you can see we just made a breakout on an absolute basis above the 2018 high. This is good action here in clothing and accessories. Home improvement, been a really rough 2 or 3 months. Not going to lie, fourth quarter 2020 has not been good. The relative PPO has gone negative. I think you got to be careful with this group right now. And just to give you a little hint, I'm going to talk about one of these companies in the 3 you must see at the end of today's show. Recreational services, yeah, kind of strengthened, but we haven't been able to get above that relative high in June. The relative PPO looks like it might be topping here just above the 0 line. I don't know. If we fall back below these 2 moving averages, I'd be careful because this is a group that really got beaten up badly in the pandemic. And yes, we have rallied some, but if the virus continues on and lingers longer than we expect in 2021, this is a group that's going to have a direct inverse impact there, or adverse impact. Apparel retailers definitely strengthening, kind of like clothing and accessories. Looks pretty good. Relative PPO good. Also, the absolute price breakout above these prior highs. So all of that looking good for apparel retail. Specialty retail looks a little bit like software to me. We had great relative strength, worked our way back close to that 50-week moving average. Here we've seen the PPO, relative PPO, turn a little bit negative. So we got a little bit of work still to do there. Travel and tourism strengthening, looking pretty good. The absolute price breakout, I expect we're going to see more strength here. Expedia actually looks pretty good in that group. Gambling stocks, they've improved, but they're kind of like, hotels and some of these others where we've seen some strength, but they're rolling back over, maybe like recreational services. Watch these moving averages. I wouldn't want to see us go back down below those. Home construction normally loves the months of December and January, believe it or not. Doesn't quite seem right, but those are 2 months that this group does pretty well. But you can see we are struggling, definitely weakening as we move forward. Broadline retail, this is an area I expect to see broadline retail begin to strengthen again. Watch for a breakout in the broadline retail index up around 3,400. That would be your sign. Furnishings, definitely strengthening. PPO is strong, so things are getting better. Watch the moving averages, though. Make sure they continue to hold. Footwear, one of my favorite groups in the market, just broke out again recently on a relative basis. Look at the absolute move to the upside. Huge, huge, huge winner here. All right, just a couple more. Going to try and get through these kind of quick. Business training and employment agencies strengthening, but rolling back over. Watch those moving averages. Durable household products also rolling over. Couldn't get through that prior high. Rolling over. Watch that 50-week. Automobiles, what can I say? Continues just to blow the doors off the market. Just crushing the S&P. Best performing area in the market, no doubt. Recreational products on a relative basis going sideways, but on an absolute basis continues to move higher. I think that group looks good. Auto parts strengthening. Still got some work to do to take out that November 2019 high. All right, let's move on to Mailbag. Got a question on the PPO, and basically the question is, what do I think of the PPO? And what do I use it for, kind of a thing? Well, PPO is a momentum indicator. So you can see the PPO moving up here. When I see that, normally I look for a 20-day test. Now, this particular chart, Apple, I wrote an article in Don't Ignore This blog, or Don't Ignore This Chart blog, back on December 30th. And that's when this dark cloud cover reversing candle printed right at price resistance. And I said it looks like we're probably going to see some short-term selling on Apple, and I pointed out the 20-day moving average. Well, let's fast forward. Here's our 3 days of selling after that reversing candle. Went below the 20, but we held on the close. So when I see a strengthening PPO like this, I look for a 20-day test. That's where I would consider entering from a short-term trading perspective. Now, if we close below the 20, you can always just get out, wait for things to strengthen again. I believe we've got a cup. I think eventually we're going to make this breakout. And when we do, it's going to measure up probably about another 35 points or so. So I'm going to be looking for a 170 to 175 target there. All right, let's go into the 3 you must see. Let's wrap this thing up. And I'm going to start with Home Depot. I've mentioned home improvement. You want to be careful. Well, Home Depot has been coming down and testing this 260 area for the last 4 or 5 months. Resistance 290, support 260. We did it again. We went to 261 on Monday before bouncing back to the upside. I think you got to be really careful with Home Depot here. A close below 260, especially if that volume picks up, and I wouldn't take any chances. I would be out of it. Next up, and this one I like a lot more, this is Caterpillar. Now, Caterpillar's been trending higher, went up to a high of about 182 or so, 183, back maybe a month ago. Tried to break out on Monday, even though the market was weak, and they'd come back down and fail. So I think short term, we might have to be a little careful, but I think we're going higher on Caterpillar. I really like what's going on here. Last one I wanted to go over is Zoom. I really like Zoom, and I've been saying for a while, even though stock keeps getting hit to the downside, I think we had support 350, price support. We had gap support around 325. Tried to make a reversal on increasing volume on Monday. I don't know if that's going to work. Got to get back through that 20-day. If we do, I think we'll start to see a long-term cup form here. But I believe in 2021, we're going to make another run for 550, 600. But we'll see. Have to kind of play it by ear. All right, that is it for me. I want to thank everybody for tuning in. Again, Happy New Year. Wishing everyone the best in 2021. Stick with me here, Trading Places Live. I'll do my best to keep you apprised of what's going on in the market. What I see coming forward right now, I'm very bullish as we look ahead. Everybody have a great Tuesday. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.